CME halted silver trading. Again, November 2025, then March 2026. 2 halts in 4 months, and each time the official explanation is technical issue. But Eric Sprott, the billionaire resource investor who's been in this game for 5 decades, isn't buying it. He's saying something I keep thinking about. The paper market has lost control of the physical metal. And if he's right, if the largest silver investor in the world is publicly stating that a historical short squeeze has already begun, I keep asking myself one question. Why isn't everyone paying attention? My theory is this. Most investors don't understand the difference between paper silver and physical silver. They don't understand how leverage creates fragility. And they definitely don't understand what happens when a market built on 100-to-1 paper to physical ratios faces delivery demands it can't meet. Let me show you the pattern. Because we've seen commodity squeezes before, and every time 2 groups emerge. Those who positioned in physical before the break, and those who held paper contracts that became worthless. I'm not a financial advisor. This isn't financial advice. This is pattern analysis based on commodity market structure, historical squeeze mechanics, and institutional positioning data. And what I'm seeing suggests we're not at the beginning of a silver rally. We're at the beginning of a structural market break where paper and physical prices decouple permanently. Let me show you why. Let me give you the framework first. Because understanding how markets break is the only way to position before they do. 4 stages. Every commodity squeeze follows this sequence. Stage 1 is paper dominance. For decades, commodity markets are controlled by paper contracts, futures, options, ETFs, certificates. The paper market is 50 to 100 times larger than the physical market, and that works fine as long as most traders settle in cash, not metal. Prices are determined by paper trading, not physical supply and demand. Stage 1 is stability through leverage. Stage 2 is physical tightening. Something changes. Industrial demand increases. Mine supply decreases. Above-ground inventories drain. But the paper market doesn't reflect this immediately because most contracts still settle in cash. Physical buyers start going directly to producers. Premiums over paper prices begin rising. But it's gradual. Most people don't notice. Stage 2 is when smart money recognizes the divergence and starts accumulating physical. Stage 3 is paper stress. Delivery demands increase. Exchange inventories can't meet them. Trading halts occur. Margin requirements get raised. The system tries to discourage physical delivery and encourage cash settlement. But some buyers refuse. They want metal, not promises. And when enough buyers demand delivery simultaneously, the paper market loses credibility. Stage 3 is when the divergence becomes visible. This is where we are right now, according to Sprott. Stage 4 is dislocation. The paper market either forces cash settlement, destroying trust, or allows delivery failures, destroying the exchange's credibility. Either way, physical and paper prices split. Physical trades at massive premiums. Paper contracts become essentially worthless unless you can take delivery, which most can't. And the people holding physical metal realize they own an asset worth far more than the spot price suggests. Stage 4 is the wealth transfer, from paper holders to physical holders. Now let me show you why Sprott thinks we're in Stage 3 heading to Stage 4. First, the CME trading halts. November 2025, silver trading halted for hours during a price spike. Official reason? Cooling system failure. March 2026, another halt during a massive sell order. Official reason? Technical glitch. But veteran traders know, when exchanges halt trading during extreme moves, someone big is in trouble. Either a large short position is getting squeezed, or delivery demands are threatening system stability. One halt could be coincidence. 2 halts in 4 months is a pattern, and patterns reveal stress. Second, the short position data. According to Sprott's analysis, banks and institutional traders hold massive short positions in silver. These positions were established when silver was $18, $20, $22 per ounce. Now silver is approaching $100. If you're short from $20 and silver is at $100, you're down 400%. That's not a loss you can absorb easily. You either cover by buying back at massive loss, or you pray for a collapse. But if physical demand is accelerating and supply is constrained, collapse isn't coming. The squeeze tightens. Third, the physical market signals. Sprott points to companies like Samsung sourcing silver directly from mines. Normally, industrial users buy from refineries or dealers who source from exchanges. But if Samsung is going directly to mines, that means the normal supply chain isn't working. It means they can't source the quantities they need through traditional channels. And if a company the size of Samsung can't source silver normally, what does that tell you about overall availability? Fourth, exchange inventory data. COMEX registered silver, the amount available for delivery against futures contracts, is under 60 million ounces. Open interest represents claims on roughly 800 million ounces. That's a 13-to-1 ratio of claims to metal. If even 10% of contract holders demand delivery, the system can't fulfill it. And that's the mechanism of a squeeze. Not everyone demanding delivery at once, just enough people demanding it that the exchange can't cover. Now let me show you the India angle, because this could be the catalyst that triggers stage 4. According to reports, India is implementing a mandate requiring approximately $385 billion in fund flows to be diverted into precious metals starting April 1st. Let me put that in context. The entire global investable silver market is estimated at $200 to $280 billion in total market cap. If even 10% of India's $385 billion mandate flows into silver, that's $38.5 billion chasing a $250 billion market. That's a 15% increase in total demand. And unlike speculative flows that come and go, this is regulatory mandate. It's structural, it's sustained. Here's the mechanism. Indian investors, pension funds, and institutions will need to comply with the mandate. They'll buy gold and silver. But gold market is much larger and more liquid. Silver market is smaller. So the price impact on silver will be disproportionately larger. If gold absorbs 70% of the flows and silver absorbs 30%, that's still $115 billion into a $250 billion silver market. That's a 46% demand surge. How does price respond to that? It gaps violently. Now let me show you historical squeeze patterns, because this has happened before in other commodities. Example 1, palladium, 2000-2001. Russia controlled 60% of supply. They delayed shipments. Physical market tightened. Paper traders couldn't source metal for delivery. Price spiked from $400 to $1,100, 175% in 18 months. The people holding physical palladium made fortunes. The people holding paper contracts that couldn't be delivered learned expensive lessons. The pattern? Physical scarcity plus delivery demands equals price explosion. Example 2, rhodium, 2019-2021. Automotive industry needed rhodium for catalytic converters. Supply was tight. Above-ground inventories low. Price went from $2,500 to $29,000 per ounce. That's 1,060% in 2 years. Not because of speculation, because industrial users needed the metal and supply couldn't meet demand. The lesson? When industrial demand is real and supply is inelastic, price becomes the only adjustment mechanism. Example 3, uranium, 2006-2007. Nuclear power demand increasing. Mine supply flat. Kazakhstan flooding disrupted production. Spot price went from $20 to $137 per pound. 585% in 2 years. Again, physical scarcity plus demand equals explosive price action. The pattern repeats across commodities. Now apply this pattern to silver. Industrial demand growing. Solar panels, electric vehicles, 5G infrastructure, all consuming more silver. Mine supply flat to declining. Above-ground inventories draining. And now, India mandate potentially adding $38 to $115 billion in sustained demand. The setup is more extreme than palladium, rhodium, or uranium, because silver has both monetary and industrial demand. It's the only metal that serves both functions at scale. Now let me address the gold-silver ratio argument. This is where Sprott's $300 silver thesis comes from. Currently, the gold-to-silver ratio is around 56 to 1. That means it takes 56 ounces of silver to buy 1 ounce of gold. But the mining ratio, the amount of silver mined relative to gold, is approximately 8 to 1. For every ounce of gold mined, about 8 ounces of silver come out of the ground. So why is the price ratio 56 to 1 if the production ratio is 8 to 1? Because for centuries, gold was money and silver was industrial. The price ratio reflected that functional difference. But something is changing. Silver is becoming monetary again. Central banks aren't buying it yet, but investors are. Physical demand is surging. And if silver becomes both monetary and industrial, while gold is primarily monetary, the ratio should compress. Historically, the ratio has traded as low as 15 to 1. If it reverts to 15 to 1, and gold is at $5,500, silver would be $367. If gold goes to $6,000 and the ratio is 15 to 1, silver is $400. That's the mathematical setup. It's not speculation, it's arithmetic. The question is whether the ratio actually compresses. And if India mandate creates sustained buying pressure, compression seems likely. Here's the mechanism. If $115 billion flows into silver over months, and the total market cap is $250 billion, the market cap would need to grow to $365 billion to absorb that flow without price impact. But market cap growth requires price growth. If ounces are relatively fixed in the short term, you can't mine significantly more silver quickly. Price must rise to create the market cap needed to absorb the flows. How much? If market cap needs to go from $250 billion to $365 billion, that's 46% growth. If silver is at $95, 46% growth is $139. But that assumes linear absorption. In reality, as price rises, it creates momentum. Momentum attracts additional buyers, and additional buyers push price further. That's how markets overshoot. Now let me address the junior mining thesis. Sprott suggests 20 to 30 times potential in junior silver mining companies. That sounds insane until you understand the leverage mechanism. A junior mining company with a silver deposit operates on thin margins. If silver is at $25 per ounce and their all-in cost is $20, they make $5 per ounce profit. If silver goes to $100, they make $80 per ounce profit. That's 16 times more profit per ounce. But the stock doesn't just go up 16 times. It might go up 30 times because future earnings get capitalized at higher multiples when commodity prices are rising. This happened in the 1970s gold mining stocks. This happened in 2000s when gold ran. And it could happen again in silver if the thesis plays out. But here's the critical caveat. Junior mining stocks are extraordinarily risky. Most fail. Many are poorly managed. Some have questionable reserves. The 20 to 30 times return is possible for the winners. But picking the winners is difficult, and the losers go to zero. So if this thesis interests you, understand the risk. This isn't buying physical silver and holding it. This is speculating on operational execution, management quality, reserve verification, and commodity price movements simultaneously. The leverage works both ways. Here's the positioning framework Sprott seems to advocate, and I'm presenting this as his view, not advice. Core position in physical silver. Coins, bars, allocated storage. This is the foundation. No counterparty risk. You own the metal. Then, a smaller allocation to the best-in-class silver mining companies. Large, established producers with low costs and proven reserves. Then, an even smaller allocation to carefully selected juniors with strong management and verified deposits. The allocation pyramid. 70% physical, 20% senior miners, 10% juniors. That structure gives you metal protection, mining leverage, and junior upside without being destroyed if the thesis is wrong. Now let me show you the timeline scenario Sprott seems to envision. April 1st, India mandate begins. Initial flows start entering precious metals markets. Silver tests $110 to $120 as first wave hits. Q2 2026, sustained flows continue. Industrial demand remains strong. Mine supply can't respond quickly enough. Silver consolidates $120 to $140. Some volatility but uptrend intact. Q3 2026. If physical shortages become acute, if refineries can't meet demand, if paper market credibility erodes further, silver could test $160 to $180. Q4 2026 into 2027. If the squeeze fully manifests, if the gold-silver ratio compresses toward 20 to 1, and if gold itself is rising, silver could approach $200 to $250. And in an extreme scenario, where the ratio hits 15 to 1 and gold is at $6,000, you get the $300 to $400 silver Sprott mentions. Is that guaranteed? Absolutely not. Is it possible? Based on historical commodity squeezes, ratio reversion mathematics, and demand-supply fundamentals, yes, it's possible. The question is probability, and I can't give you a number, but I can give you the framework to assess it yourself. Here's what concerns me about the squeeze thesis. Squeezes are inherently unstable. They create extreme volatility. Silver could go from $100 to $140, back to $110, then to $160, all in 3 months. The people who can hold through that volatility profit. The people who panic sell at $110 after buying at $120 get shaken out before the move to $160. So even if the thesis is correct directionally, execution requires psychological resilience that most people don't have. Second concern. Governments and exchanges have tools to disrupt squeezes. In 1980, COMEX changed margin requirements and position limits to break the Hunt brothers. They could do it again. If silver goes too high too fast, regulatory intervention becomes likely. Does that kill the move? Maybe. Or maybe it just delays it and creates a better entry point. History suggests commodity fundamentals eventually win over regulatory interference. But the path isn't smooth. Third concern. If the India mandate is delayed, reduced, or less impactful than expected, the entire catalyst is weaker. We're relying on regulatory implementation in a foreign jurisdiction. That introduces execution risk. If India changes course, the timeline extends or the thesis weakens. Now let me show you the alternative scenario, because balance requires acknowledging what could go wrong. If industrial demand slows due to economic recession, if India mandate flows primarily to gold, not silver, if new silver deposits get developed faster than expected, if the paper market successfully discourages delivery demands through regulatory changes, the squeeze doesn't happen. Silver might consolidate at $90 to $110 for years. You don't lose if you own physical, but you don't get the explosive move either. And junior mining stocks, which are priced for the explosive move, could fall 50% to 70% if it doesn't materialize. Here's the risk framework. Physical silver has limited downside if you believe in the long-term monetary and industrial thesis. Even if the squeeze doesn't happen, silver at $90 to $100 in a world of monetary expansion and industrial demand growth seems sustainable. Senior mining stocks have moderate risk. They're leveraged to silver price, but they have operational cash flows and tangible assets. They can survive even if silver consolidates. Junior mining stocks have extreme risk. They're essentially options on the squeeze thesis. If it happens, 20 to 30 times. If it doesn't, 70% to 90% loss. Position sizing must reflect that risk profile. Here's what I'm watching to validate or invalidate the thesis. First, India mandate implementation. Does it actually happen April 1st? Do flows start entering markets? Second, COMEX delivery demands. Are more traders demanding physical? Are registered inventories continuing to drain? Third, physical premiums. Are premiums over paper prices widening? Fourth, industrial sourcing patterns. Are more companies going directly to mines like Samsung? Fifth, exchange behavior. Are more trading halts occurring? Are margin requirements being raised? These are real-time signals of whether the squeeze is progressing or stalling. Let me give you the final thought on Sprott's thesis. He's been one of the most successful resource investors for 5 decades. He built a multi-billion-dollar fortune by recognizing commodity cycles early. When he goes public with a thesis this bold, it's worth studying. But studying isn't the same as blindly following. Validate the logic, check the data, understand the risks, and position according to your own risk tolerance, not someone else's conviction. The pattern is clear. Physical tightening, paper stress, delivery demands increasing, exchange halts happening, India mandate potentially adding massive sustained demand, gold-silver ratio at extreme levels. All the ingredients for a squeeze are present. Whether it materializes, how violent it is, and how long it lasts, those are the variables. But the setup is real. So here's my question. Are you going to wait for $150 silver and wish you'd positioned at $95? Or are you going to recognize the pattern, understand the mechanics, and take measured exposure while prices are still double digits? Because if Sprott is right, if the squeeze is already beginning, if stage 3 is active and stage 4 is coming, the window to position at reasonable prices is closing. Not in years, in months, maybe weeks. The choice is yours, but understand what you're choosing between. Physical silver with limited downside and potentially explosive upside. Paper silver with counterparty risk and delivery uncertainty. Senior miners with operational leverage and moderate risk. Junior miners with extreme leverage and extreme risk. Or no position, watching from the sidelines while the largest commodity squeeze in modern history potentially unfolds. If you want to follow this thesis as it develops, subscribe, because the signals are emerging weekly. India mandate implementation, COMEX inventory data, physical premiums, industrial demand reports. Each data point confirms or challenges the thesis, and understanding which scenario is unfolding in real time, that's the edge. The people who see the pattern early position. The people who wait for confirmation chase. And chasing squeezes is how you buy the top. Don't be late. The pattern is visible. The question is whether you see it.